Whether we're in a recession or not, I want to talk about the 5 tips to protect your finances. We're experiencing a difficult time where inflation is at a 40-year high, Federal Reserve raising interest rates, mortgage rates going beyond 6%, and gas prices are reaching $6, $7 per gallon. And on top of all that, the stock market like the S&P 500 is down over 20% since the beginning of 2021. Nasdaq is down over 30%, and Dow Jones Industrial is down to almost 30,000 points. Bitcoin and Ethereum suffered a 30% plus loss in just 1 week, and the S&P 500 has now lost all of its gains since President Biden was inaugurated in January 2021. So you hate seeing all the losses in your 401k or IRA. I get it, because I'm seeing a significant loss in my portfolio too. And it's difficult for people who started to invest during the longest bull market in the history of the stock market to maintain their confidence in investing. I went through the Great Recession in 2007 to 2009, and I know how the bear market could crush the confidence of millions of Americans. So instead of me telling you, why don't you just calm down because this is going to pass like every bear market, is probably not going to cut it. If you're brand new to my channel, my name is Sai and welcome. So in this video, I'm going to talk about the 5 tips to protect your finances during a recession and how to develop healthy financial habits so you're ready for the next stock market crash, inflation, or a recession. What I don't want you to do is to do something based on recessionary fears that can potentially put you in a worse financial position. I know people who have already sold stocks at a loss, and it's breaking my heart to see how people have lost confidence in building their long-term wealth. By the way, if you're someone who's always writing emails, working on school papers, or building a resume for your next dream job, you should check out Grammarly. Grammarly can proofread your writing and save you so much time and make your writing look professional. I've been using Grammarly Premium since 2018, and it saves me so much time from having to proofread my emails. I also use Grammarly to proofread my resume, which got me a job paying 6 figures in salary. You can get the free version of Grammarly, and I will put my affiliate link in the description below. Tip number 1 is to change the investment strategy from lump sum investing to a dollar cost averaging strategy. And historically, lump sum investing outperforms dollar cost averaging about 75 or 80% of the time. When you're in a strong bull market, the lump sum investing strategy can pay off more quickly. So let's use the Roth IRA for example. If you invested $6,000 on the first trading day of 2021 into the S&P 500 index fund, you would have had a 29% gain and finished the year with a total of $7,748. If you dollar cost average $6,000 and let's say you invested $230 every 2 weeks, then you would have gained only 13%. But when I say only, it's still a lot, right? 13% and finished the year with about $6,800. But how do you know what year to invest in a lump sum and what year to dollar cost average your investment? The answer is you don't. There's no point in timing the market. I personally like to dollar cost average my investments just purely for psychological reasons. And I never know when we're going to go through a bull market or a bear market every year. I just know that the bear market doesn't last forever. If I lump sum invested $6,000 at the beginning of this year and the year ends with a negative 20% return, then my portfolio would finish with $4,800. And if I dollar cost average my investment, then I'm buying my S&P 500 index fund at a discount every 2 weeks. My wife and I dollar cost average for all of our retirement accounts, and we're not going to change that strategy anytime soon. If it's impossible for anyone, and even Wall Street guys with the suits, to know the best time to get out and when to jump back into the market. And what we know is that a recession isn't forever, and the market will bounce back in the long term. Anytime the market drops 2%, 3%, or 5%, we're buying as much as we can because we believe in the long-term growth of our portfolios. By the way, you can get our free fire resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf at firesidechat.com/shopping. Tip number 2 is to get out of debt as soon as possible, especially your credit card debt if you have any. The Federal Reserve is looking to raise more interest rates this year, and if our inflation doesn't calm down anytime soon, they're probably going to become more hawkish. If you have any other debts like personal loans and auto loans on top of your credit card debt, you should probably prioritize credit cards because those interest rates are expected to rise throughout the year. You can pay off your debt using the debt snowball method or the debt avalanche method. You should check out the video I made about paying off $47,000 in credit card debt in 2 years, making $57,000 a year, and I will put that video link in the description below. Whether we're in a recession or not, you should never carry your credit card balance month over month. At some point in your life, you're going to go through lifestyle inflation because you got a raise at your job or you got married and now your expenses are split in half. If you're going to use credit cards to pay for everything, then you need to make sure you have the cash to pay it off at the end of every month. When you bite more than you can chew, this is when you start accruing debt and living paycheck to paycheck, like the 36% of Americans making $250,000 a year. Your income doesn't equate to your wealth. Your credit scores don't represent your wealth status. It's all about being intentional with your spending, savings, and investing. My wife and I get to have so much fun right now by traveling because we're completely out of debt, have a fully funded emergency fund, and save and invest 60 to 65% of our income. If you need help with your personal finances, like getting out of debt or saving more for your future, I want you to visit my website at firesidechat.com/coaching and sign up for a complimentary coaching session. Tip number 3 is to not make any knee-jerk reactions with buying or selling your investments, and that includes buying or selling your home. And I've seen people make bad decisions when they're feeling fearful or uncertain about their future. And during the 2020 stock market crash, I knew people who completely sold out of their investments in their retirement accounts because they thought it was the end of the US economy. And the market finished with almost 18% in the positive territory, and they missed out on all the gains and sold assets at a loss. Make an informed decision before you buy or sell anything in the stock market or real estate. And there are people selling their houses right now because they're predicting a housing market crash in the coming years. I don't know if there will be a housing market crash, but I believe there will be a correction as mortgage rates continue to go up. And however, it's still important to have professionals in your corner before you make the final decision to sell your house or investments. Don't sell just because you're fearful or panicking about the recession. If you're close to your retirement and you want to prevent further losses in your portfolio, find a trusted financial planner, advisor, or coach like me who can help you navigate your path to financial freedom. You and your spouses are the CEOs of your household. Your household sometimes requires financial professionals to make sure you make informed decisions. Making any knee-jerk reactions might put you in a tougher financial position for the foreseeable future. And tip number 4 is to boost your emergency fund. If you believe there's a recession coming and you're in an industry that's vulnerable to job losses or furlough, then you could boost your cash savings in an emergency fund to cover at least 6 months of your expenses. If your spouse also works, then you want to make sure your spouse's income can cover your household expenses while you're unemployed. Whenever there's a recession, one of the indicators is the rise in unemployment. And I'm already seeing reports of layoffs and job cuts in the tech sector due to the economic slowdown. Within your emergency fund, you also need a rainy day fund. And a rainy day fund is when you need cash right away to replace a blown tire, medical or dental deductibles, or something else that's urgent and unexpected. An emergency fund is used to cover your living expenses while you're looking for new sources of income. So on top of saving 6 months of your expenses in your emergency fund, I would calculate how much money it would cost to pay the deductible for your unexpected medical, dental, or vision expenses. Your insurance might require you to make a copay on an ER visit that could cost you hundreds of dollars. If your family members live outside of your area and you need to fly home in case anything happens to them, then you should find out how much money it will cost to fly home at a moment's notice. If you run over a nail tomorrow and get a blown tire, how much would it cost to replace a tire, or how much would you have to pay your insurance for the deductible? Answering these questions could give you peace of mind within your emergency fund. And tip number 5 is to redo your budget based on last month's expenses. Our grocery bill has gone up, so we had to increase our grocery budget so we could pay 13% more on a gallon of milk. And the best way to redo your grocery budget is to compile your total groceries from the previous month and use that total as a projection going into next month. Our grocery bill last year was around $600 per month, but this year we're looking at around spending on average $700 to $750 per month. Last year we kept our gas bill around $100 a month, and this year we're looking at around $120 or $140 per month. It's not that we're spending more, but things are just more expensive than last year, right? And as all of you guys know, I always recommend you stress test your budget each month and figure out your total non-discretionary expenses. What is your bare minimum budget that is strictly your mortgage payment, utilities, HOA, gas, and groceries? I strongly encourage you to have a conversation with your spouse about the contingency plans. Could you trim any more fat from your non-discretionary expenses? It is a frustrating time for millions of Americans who are struggling to live paycheck to paycheck. However, if you're working on getting out of debt as soon as possible so you can get on the FIRE journey, you have to find a creative way to make more room in your budget. It's easier said than done, right? I get it. If you want to know more about how I paid off my debt and saved my first $100,000, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.